Sydney house prices could be about to fall 14.5% and Melbourne nearly 13%. And across Australia's capital cities, one of the country's biggest banks is now expecting a 10% peak to trough decline. That's obviously a pretty dramatic prediction for a country that supposedly doesn't have enough houses. And that's what makes things interesting, because Australia's housing problem hasn't disappeared. Vacancies are still tight, construction is still difficult. There is still an underlying shortage of homes, at least that's what they tell us, but prices are falling anyway. And this week, something changed. The weakness that started in Sydney and Melbourne has spread to Brisbane and Adelaide. Regional Australia has started falling too. Buyers are disappearing. And today, the Reserve Bank admitted the housing market has weakened more than it had expected. So the question isn't whether Australia's housing market is slowing anymore. That's honestly pretty obvious to everyone now. The question is, how much further can it fall before the housing shortage underneath it starts pushing prices back up? And how long will things take? So let's start with what changed. Cotality's National Home Value Index fell 0.7% in July. That was the biggest month decline since December 2022, and Sydney fell 1.4% in just that month. Melbourne, 1.2% in July. But those two aren't the surprising part. Brisbane fell 0.6% and Adelaide fell 0.2%. And both have now declined for 2 months in a row. Perth technically managed a 0.1% gain in July. But here's the strange part. Its June number was revised down to 0.5% of a fall. So even Perth, which has been one of Australia's strongest markets, has now had a negative month. And the slowdown isn't confined to the big cities anymore. Regional Australian home values fell 0.2% in July. That's their first monthly fall since January 2023. So this is no longer Sydney is struggling, Melbourne is struggling, everywhere else is going to be just fine. The downturn is broadening, and that's the important part now. Because once weakness spreads geographically, you can't explain it away as it's just one city's affordability problem. Something is happening to Australian buyers as a whole, and you can see where exactly this is when you look at the listings. At the start of this year, Australian housing was still incredibly tight. National listings were roughly 26% below their 5-year average in mid-January. By late July, that shortage had almost completely disappeared. National listings were only 1.1% below the average. And across capital cities, advertised supply is now 5.7% above its 5-year average. That doesn't mean Australia suddenly built millions of houses, because obviously it didn't. It means demand weakened faster than supply did, and auctions tell the same story. Capital city auction clearance rates have been below 50% since late May. ANZ said they've now been below 50% for the last 10 weeks. NAB says homes are now taking a median 34 days to sell. That's the longest in 5 years. So sellers are still there, the houses are still there, but fewer buyers are stepping back in to pay the prices that were there yesterday. And that's the first big misconception about housing shortages. You do not need an oversupply of houses for prices to fall. You just need an undersupply of buyers. And Australian buyers have had a brutal year. The Reserve Bank has raised interest rates 3 times in 2026. Today it decided not to make it a 4th. Luckily, the cash rate stays at 4.35%, but this wasn't the kind of pause borrowers were hoping for. The RBA still says inflation is too high, and it explicitly said it could raise rates again if inflation risks worsen, which puts buyers in an awkward position. House prices are falling, but borrowing hasn't suddenly become cheaper. In fact, the RBA says new housing lending has declined noticeably, and scheduled mortgage repayments have climbed back towards their 2024 peak as a share of household income. Then you've got the property tax changes announced in the federal budget. The RBA specifically identifies those tax changes, higher rates, and the broader economic environment as contributors to the housing slowdown. And even the labour market has softened slightly. Unemployment was 4.4% in June, higher than the RBA expected back in May. None of those things individually destroys the housing market, but stack them all together and you've got higher mortgage costs, you've got lower borrowing capacity, you've got nervous investors, of course, weaker confidence, softer jobs market, and suddenly that enormous pool of buyers willing to bid property higher becomes much smaller. And this is where today's ANZ numbers get just a touch interesting, I think, because in April, ANZ expected Australian capital city house prices to rise 2.8% this year. Today, they expect them to fall 4.3%. It's a 7.1 percentage point swing in 2026 in just 4 months. Now, we've seen this all before from the banks. So we take what they say with a grain of salt and we focus on the data ourselves and understanding how we identify the data as opposed to the analysts and economists at the banks. Because, mate, you asked them in 2020, they screwed up royally, telling everyone the property prices would fall 30%. That's not how the 18-year cycle works. So now ANZ thinks the full peak to trough correction looks like this. Sydney, minus 14.5%. Melbourne, nearly 13% down. Now they're looking at Adelaide being 10% down. And for Brisbane, little old Brisbane, minus 8%. Now, with Perth, they're just looking at 5%, but I think they're just following the headlines, to be honest. Combined capital cities, they're looking at negative 10%. Again, the banks, take it with a grain of salt, but this is where some of the data is coming from that the mainstream is looking at. So ANZ isn't alone on this. NAB now expects capital city prices to fall about 5% this year, led by around 10% falls in Sydney and Melbourne. So this isn't a question of economists just adjusting their forecasters, which they often do, right? They're completely rewriting them. And the RBA itself said today that the established housing market has slowed by more than it expected. That's the real story. So what the RBA says is just telling us what has actually happened. Now we've got the forecast of the banks, but we're going to get to how to interpret all of this data in line with the 18-year cycle. But let's get back to the prices. Prices are falling. We've talked about that for weeks now, and they're falling even faster than the professionals forecasting them have expected. Now, here's where this gets a little bit more interesting and complicated. Australia doesn't have too many houses. NAB says vacancy rates remain low and the rental growth remains elevated. And ANZ says the supply shortage and construction constraints are exactly why it struggles to see house prices falling indefinitely. So how can Australia have a housing shortage and falling house prices at exactly the same time? Because those two things seem to be different. A housing shortage measures how many homes people need. A house price measures how much the next buyer can actually pay. Imagine 10 families want one house. That's an enormous shortage. But if the bank will only lend the highest bidder 700 grand, the house doesn't sell for 900 grand just because 11 people want it. We've reduced the speculation out of the market. Demand without borrowing capacity isn't effective demand. And that's basically what's happening right now. Australia still needs housing, but higher rates have lowered the amount buyers can finance. So the price has to meet the buyer, not the other way around at this stage. That also explains something that sounds contradictory. Rents can stay expensive while property values fall, and that obviously increases the yield. Vacancy rates can stay low while auction clearance rates collapse. Builders can struggle to supply enough new homes while existing homeowners cut their asking prices. There's different parts of the same market, and there's another reason the timing is pretty interesting. There's a property market theory we've obviously talked about before called the 18-year cycle. Fred Harrison came up with it, Phil Anderson improved on it, well, let's say using the US data, of course. What happens is about 14 years of expansion followed by around 4 years of contraction. Anderson bases his versions of the model on the US land and property history. The last major US housing cycle bottomed around 2012. And so we expand out about 14 years and you get to approximately 2026, which according to this framework puts us near the end of the expansionary part of the cycle, the winner's curse phase. And Australia matters here because we're suddenly seeing some of the conditions you'd expect near a turning point. Prices stretched relative to incomes, borrowing costs elevated, listings rising, transactions weakening, and forecasts being revised sharply lower. Now sure, that doesn't mean the 18 years have passed, therefore housing crashes tomorrow, but it does mean the Australian slowdown is happening at a natural point in the broader property and economic cycle. So does that mean Australia is heading for a giant housing crash? Not necessarily, and this is where I think a lot of the crash predictions go too far. ANZ expects the market to start recovering in the second half of 2027. I'll get to that in a future video, but speaking of what the mainstream is looking at, which is why we cover the banks, economists and analysts, their argument is that eventually lower rates collide with the same old supply problem. They expect 50 basis points of RBA cuts to help prices recover, with capital city values rising again in 2028. And they're probably right about one other part. Australia isn't suddenly swimming in empty homes. This isn't a classic oversupply story. But that's also why the next 12 months matter so much, because there's a battle happening between two forces. Here we are. On the one side, Australia's structural shortage of housing. On the other, the amount of people can actually afford to borrow. For years, the shortage won. Right now, little different here. Credit seems to be winning. So forget trying to predict whether Australian housing prices fall exactly 10.6%, 8%, 15%, or whatever it is. There's really only three numbers that decide what happens next. Let's go through them. First, auction clearance rates. They're currently below 50%. If they start climbing consistently back above the 60% level, that's evidence buyers are returning. Secondly, unemployment. Right now, it's at 4.4%. If it starts moving materially higher, this stops being just an affordability correction and starts becoming a forced selling problem. People don't have jobs, they've got no money. And third, the RBA. Today they paused at 4.35%, but they haven't declared victory over inflation just yet. If the next move eventually becomes a rate cut, buyers get some relief. If inflation forces another hike, the housing downturn gets another leg. But watch out for dead cat bounces as well. And that's what makes Australia's housing market so unusual right now. The country still doesn't have enough houses, but for the first time in a while, that might not be the most important part of the whole shortage. Because right now, Australia seems to be running short of something else. Buyers who can afford the prices to sell and that still want to buy. Until that changes, the housing shortage may not be enough to stop prices falling. But that isn't necessarily bad news. Australia spent years with house prices growing much faster than incomes, pushing ownership further out of reach for younger buyers. A controlled correction changes that equation. If prices cool while wages keep growing, inflation coming down, and the RBA eventually gets room to cut rates, affordability can improve without needing the entire housing market to collapse. And that would be the absolute best case scenario. And because Australia still has a genuine shortage of homes underneath all of this, there is a natural flaw that markets like the US in 2008 simply didn't have. So the best case scenario from here isn't another housing boom. It's something much less exciting, and sometimes markets need that. Prices cool, incomes catch up, rates eventually come down, and buying a home becomes slightly less ridiculous. And for a lot of Australians, that would actually be a pretty good outcome. If you want to let me know what you think happens, please leave a comment below. You know I read all of them and try to reply to as many as I possibly can. I also cover Bitcoin and other markets on my other channel, Jason Pizzino. There's a link in the video description for that. I'll see you guys in the next video. Until then, take care and peace out.